Imagine you're using a corporate credit card for, well, massive, unavoidable business expenses.
Right, like the stuff you absolutely need to keep the lights on.
Exactly. So the bill comes due today, and you have to pay it out of your own pocket immediately just to keep the business running.
Ouch.
Yeah, right. And your accounting department, they promise to reimburse you, but their policy is to wait 60 days before they actually cut you a check.
Which is, I mean, a nightmare for your personal cash flow.
It looks absolutely terrible. For those 60 days, you aren't actually any poorer. I mean, the money is guaranteed to come back. But if someone looked at your bank account in that specific, 2-month window, they might think you were going bankrupt.
They'd think you were totally underwater. Yeah.
Exactly. So today, we were looking at a company that just pulled off a corporate version of exactly that scenario.
And why that temporary accounting illusion might actually be, well, the ultimate buy signal for your portfolio.
It really might be. Welcome to the deep dive, everyone. Now, usually when we look at a company, we're trying to figure out what they do, right? You look at a tech stock, they make software.
Right.
You look at an automaker, they build cars. It's usually a single neat little box. But today, we're putting on our Talk Tickers hats.
Oh, absolutely.
We are looking for those highly actionable, data-forward, opinionated takeaways. But because the mechanics of this specific company are so uniquely complex, we're going to do a massive structural deep dive. We really need to unpack the why behind the numbers today.
Yeah, we have to. You can't just skim the surface on this one.
No, you definitely can't. We're looking at Kirby Corporation, ticker symbol KEX. We are breaking down their Q2 2026 earnings call. And the mission today for you listening is simple. We want to get you the absolute most important actionable insights from this call, custom tailored for how you construct your portfolio.
And to do that, we have to evaluate the two entirely different engines driving this machine. Kirby is, well, it's what you could call a dual threat business.
Okay, let's unpack this. Because they really do refuse to fit into one single category.
They really do.
On one side, they operate the largest fleet of inland tank barges in the United States. That's their marine transportation segment.
Right, moving the physical stuff.
Yeah, but on the other side, they sell, service, and maintain massive engines and power equipment. That's their distribution and services segment.
Two totally different businesses just living under one roof.
Exactly. So let's kick off this Talk Tickers analysis with the hard numbers. Let's look at what they actually reported.
Yeah, the headline numbers for Q2 2026 are where this whole narrative really begins. And they require some immediate context.
For sure.
Let's start with earnings per share, or EPS. Kirby reported an EPS of $1.67.
Okay, $1.67.
Right. And sequentially, meaning compared to the first quarter of this year, that is an 11% increase.
That sounds pretty good.
It does. But if you look at it year over year, so compared to Q2 of 2025, it's essentially flat. It came in exactly in line with the prior year.
Okay, so flat year over year on the bottom line. But, when you look at the top line, the total revenue, that tells a much different, honestly, much more aggressive story.
Oh, absolutely.
Total revenue came in at $922.4 million. That's a solid 8% increase year over year.
Not bad at all.
Not at all. And when we split that revenue between those two distinct businesses we talked about, it looks robust across the board. The marine transportation segment hit $537 million, which is a 9% jump.
Right.
And the distribution and services segment, which they call D&S, hit $385.4 million. That's a 6% increase. So revenues are growing nicely in both halves of the business.
They are. But if you're an investor reading this earnings report, parsing through the data, your eyes immediately lock onto a glaring, almost alarming mismatch in the marine segment.
Yeah, the mismatch is crazy.
Right. Marine revenues grew 9%, yes. But marine operating income, like the actual profit generated from those daily barge operations, declined by 11% year over year.
Wait, down 11%?
Down 11%. It dropped down to $87.8 million.
This is the part that made me do a double take. Revenue is up nearly double digits, but operating income is down double digits.
It's a head scratcher.
It really is. To go back to that corporate credit card analogy, the revenue shows the business is booming, but the operating income makes it look like the cash is just, vanishing. What exactly is draining the bank account here?
Well, the revenue growth is completely real. The barges are moving. The demand from refineries is definitely there. But the margins, the actual profitability of that revenue got squeezed by two very specific operational realities during the quarter.
Okay, what were they?
The first was a sudden rapid spike in marine fuel costs. And the second was elevated shipyard activity in their coastal fleet.
Okay, let's break that down because elevated shipyard activity sounds like a very polite corporate way of saying our boats were broken and we couldn't make money.
Yeah, it does sound like that.
Right. Like, is management just bad at scheduling, or is there a structural reason these boats were out of the water?
It is entirely structural, actually.
Yeah.
And it's a fascinating quirk of the maritime industry. These vessels weren't broken down because of, like, negligence or something.
Okay, so what was it?
They were out of service for legally mandated maintenance. In the marine industry, vessels are required by federal law to undergo rigorous inspections and maintenance at regular intervals. They often call them Coast Guard majors.
Coast Guard majors. Got it.
Yeah, so we're talking about pulling massive coastal vessels out of the water, putting them in a dry dock, inspecting the whole thickness, replacing steel plating, overhauling the propulsion systems, and applying specialized marine coatings.
Wow. Okay, so this isn't like taking your car in for a quick oil change on a Tuesday.
Not at all.
This is essentially tearing the vessel down to the studs to prove to the Coast Guard that it, won't sink or leak chemicals into the ocean.
Exactly. And, when a boat is in the shipyard getting steel replaced, it is not in the water generating revenue. But you are still paying for the shipyard labor, the raw materials, and you're absorbing the massive opportunity cost of that vessel sitting idle while customer demand is high.
So it's a double whammy. You're losing money and spending money at the same time.
Precisely. And Kirby knew this was coming for the coastal fleet. It's mapped out years in advance based on the statutory age and inspection cycles of the vessels.
Right, they can see the calendar.
Yeah, but even though it's scheduled, when multiple heavy maintenance cycles hit in a single quarter, it heavily impacts the operating income for that specific 3-month window.
Okay, so the shipyard dynamic makes sense. It's just a necessary evil of operating heavy industrial assets. But let's talk about the fuel costs, because that is where the margin really got compressed. And I have to push back here for a second.
Sure, go for it.
Why wouldn't a transportation company just raise their prices immediately when fuel goes up? Like if you run a trucking company and diesel spikes, you slap a fuel surcharge on the invoice the very next day, right? Don't they have contracts for that?
What's fascinating here is exactly how those marine contracts are structured and how the accounting actually works behind the scenes.
Okay.
Kirby does not want to be in the business of speculating on fuel prices.
Yep.
The CEO, David Grzinski, explicitly stated on the call that they don't want to make money on fuel and they don't want to lose money on fuel.
They just want to move the stuff.
Exactly. They view it purely as a pass-through cost to their customers. And remember who their customers are: refineries and chemical plants.
Right.
Those customers actually trade in petroleum products all day long. They are far better equipped to handle and hedge that price volatility than a barge operator is.
Right. So Kirby essentially says, look, we will provide the boat and the crew, but you, the refinery, are ultimately responsible for the cost of the fuel it takes to move your product.
That's the deal.
But if it's a pure pass-through cost, why did it hurt their Q2 profits so badly?
It all comes down to the time lag built into the billing cycle. When marine diesel prices suddenly rip higher like they did in March and April, which, by the way, Grzinski noted was a very sporty environment for Gulf Coast fuel prices, Kirby has to buy that expensive fuel immediately in the open market just to keep the towboats moving.
Because the engines don't stop running just because prices are high.
Exactly. But their long-term contracts with these refineries have escalation clauses that only reset every 30, 60, or 90 days, depending on the specific agreement.
Wait, hold on. If fuel prices stay elevated indefinitely in a, sporty market, doesn't that 60-day lag become a permanent rolling drag on their cash flow?
I see where you're going.
Yeah, like why are we assuming fuel prices just magically stabilize and they get all their money back? If the price stays high, they're always buying expensive fuel today and getting reimbursed for last month's slightly less expensive fuel.
That is a very sharp question, and it's exactly why this accounting dynamic trips up so many retail investors.
Okay, explain it to me.
You're describing a scenario of continuous, month-over-month compounding inflation in fuel. If fuel went up 10% every single month forever, yes, the lag would be a permanent drag. But that isn't how petroleum markets work.
Right, they fluctuate.
They spike, and then they plateau or they revert. The critical mechanism here is that the reimbursement formula in the contract captures the actual cost incurred over the previous period.
Okay.
So if Kirby pays $2 a gallon in January and it spikes to $3 in February, Kirby absorbs that $1 loss in February.
Right, that's the pain point.
But when the contract resets in March, The customer is now paying a surcharge based on that $3 fuel. If the price in March plateaus at $3, Kirby's now being fully reimbursed for their current fuel cost.
Ah, I see. So the margin compression only happens during the acceleration frenzy of the price spike.
You got it.
Once the price levels off, even if it levels off at a historic high, the 60-day contractual reset catches up, the billing adjusts, and the margins normalize.
Precisely. Management estimated this specific time lag created a 5 to 10 cent per share headwind in the second quarter.
Wow, that's significant.
It is. The fuel spiked rapidly. They paid the high cash price out of pocket, but the quarter ended before the 60-day billing resets could generate the reimbursement revenue. But, and this is the key, they expect to recover virtually all of those costs in the third quarter as those contractual mechanisms finally kick in and the invoices go out.
So the margin miss is a complete head fake.
100%.
It's not a structural flaw in the business. It's literally just an accounting lag. The cash isn't lost. It's just delayed by a billing cycle.
Exactly.
This is exactly why we have to dig past the headline numbers on talk tickers. If you just read the press release that operating income dropped 11%, you might panic and sell a perfectly healthy business.
And a lot of people probably did.
Right. But when you understand the mechanics of a 60-day fuel reimbursement lag, you realize the fundamental earning power of the fleet hasn't changed at all.
Which is why we need to move past the temporary accounting noise, and look at what those physical assets are actually doing out on the water.
Yes, let's do that.
The accounting explains the temporary margin drop, but to see if this company can actually sustain its growth and its cash flow generation, we need to look at the physical reality of the marine business right now.
And that physical reality is that Kirby's fleet is, for all intents and purposes, entirely sold out.
Completely sold out.
Let's look at the supply and demand dynamics because this is where the pricing power originates. On the inland marine side, so these are the tank barges moving along the Mississippi River system, and the Gulf intracoastal waterway utilization is in the low 90% range.
Right.
And in the coastal marine segment, the massive ocean-going vessels moving along the eastern seaboard and the Gulf Coast utilization is in the high 90% range.
And we really need to translate what a 90% utilization rate actually means in the physical logistics space. It does not mean they have 10% of their boats just sitting at the dock waiting for the phone to ring.
Right, because 90% sounds like you have some spare capacity, like, a hotel with 10% of its rooms empty.
But a barge is not a hotel room.
Right.
In the marine transportation world, a utilization rate in the low to mid 90s effectively means you are running at 100% maximum physical capacity. You have to account for turnaround times.
Like unloading and stuff.
Exactly. When a barge delivers a load of heavy crude oil to a refinery, it can't instantly teleport back to the origin point. It takes time to physically unload. And more importantly, it takes time to clean the barge.
Oh, I didn't even think about cleaning.
It's huge.
Yeah.
If a barge just carried black oil and the next customer needs it to carry refined diesel or a sensitive petrochemical, that barge has to go to a specialized facility to be stripped, steamed, and cleaned so there's zero cross-contamination.
So that missing 5% to 10% of utilization isn't idle capacity. It is just the necessary friction of moving massive industrial assets through a physical network.
Yes, it's cleaning time, repositioning time, waiting for locks and dams on the river system to clear.
Effectively, every available boat is working as hard as it possibly can.
Exactly. And when every boat is working and the network is physically maxed out, pricing power violently shifts to the guy who owns the boats.
Which is Kirby.
The earnings call noted that inland spot market rates, which is the price a customer pays to hire a barge for a single immediate trip right now, are rising in the low to mid-single digits sequentially.
Okay.
Meaning quarter over quarter, the price just keeps ticking up. And their term contracts, the multi-year deals that make up the bulk of their revenue, those are also renewing higher as they expire.
But why is demand so strong right now? What is driving all this traffic on the waterways? If we're, transitioning to a greener economy, shouldn't demand for moving petroleum products be slowing down?
It comes down to the fundamental strength and the unique global positioning of the Gulf Coast refining complex. In industry terminology, this is known as PAD3.
PAD3, Petroleum Administration for Defense District 3.
Yep, that's the one.
For anyone not deeply steeped in energy logistics, PAD3 essentially covers the entire Gulf Coast: Texas, Louisiana, Mississippi, Alabama, Arkansas, and New Mexico.
It is the beating heart of American refining and petrochemical manufacturing. And right now, as Kirby COO Christian O'Neill pointed out on the call, PAD3 is winning on a global scale.
Okay. How so?
We have to look at crack spreads. A crack spread is the profit margin a refinery makes by buying raw crude oil and cracking it into finished, usable products like gasoline, diesel, and jet fuel.
Okay.
Right now, those spreads are incredibly high. They actually touched an all-time record high of $16.09 a barrel just before the call.
Wait, $16 a barrel in pure refining profit?
Yep.
So when refineries are making that kind of margin, they aren't taking days off. They are running their facilities at maximum redline capacity to capture every possible dollar before the market shifts.
And a refinery is essentially a massive, continuous chemical reaction. You can't just turn it on and off with a light switch. If you're running at maximum capacity, you need a constant, uninterrupted flow of raw materials coming in and an equally constant flow of finished products going out.
It's like a conveyor belt.
Exactly.
Yeah.
If the finished product tanks fill up because there aren't enough barges to take the diesel away, the refinery actually has to slow down production. They cannot afford to let that happen when crack spreads are at record highs. Therefore, they're willing to pay a premium to secure reliable barge transportation.
So it's a massive interconnected plumbing system, and Kirby owns the critical pipes.
That's a great way to look at it.
But there is another layer to this demand story, and it's highly geopolitical. The call specifically mentioned the return of heavy crude imports. Why does the type of oil matter so much for barge demand?
It matters immensely because of how Gulf Coast refineries are physically constructed. Unlike many refineries around the world that require light, sweet crude, the massive facilities in PDD3 were specifically engineered decades ago to process heavy, sour crude oil.
Okay, what's the difference?
Well, heavy crude is thick, highly viscous, and contains a lot of sulfur. It is harder to refine, which makes it cheaper to buy, but you need highly specialized, multi-billion-dollar equipment like coker units to break it down.
And historically, a massive percentage of that heavy, sour crude came from Venezuela, right across the Gulf of Mexico.
Correct. But over the last few years, international sanctions and political instability essentially choked off that Venezuelan supply.
Right, I remember that.
And that actually hurt Kirby's business in the short term because there was simply less heavy crude entering the Gulf Coast plumbing system to move around. Refineries had to scramble to find alternative feedstocks.
But the geopolitical winds have shifted again. The call noted that Venezuelan crude imports have surged back up to over 600,000 barrels a day.
And that is a massive catalyst for Kirby.
Why is that?
Well, when 600,000 barrels of heavy crude arrive in the Gulf Coast on a massive ocean-going supertanker, that ship cannot navigate the shallow inland waterways to reach the specific refineries.
Oh, it's too big.
Exactly. The crude has to be offloaded at deepwater terminals and then loaded onto Kirby's inland tank barges to be distributed through the intracoastal waterway to the specific coker units designed to handle it.
Wow, okay.
It's a highly localized, highly specialized logistical dance, and the sudden influx of Venezuelan heavy crude is adding intense demand pressure to an already sold-out barge fleet.
So the fundamental demand drivers, record refinery profitability, and the return of heavy crude imports are structurally sound. But, speaking of geopolitics, we have to talk about the political elephant in the room that analysts focused on during the Q&A portion of the call.
Oh, yes.
We need to talk about the Jones Act.
Yes. The Jones Act is arguably the most foundational piece of legislation for any domestic maritime company like Kirby. It's a federal law, officially known as the Merchant Marine Act of 1920.
1920, so it's been around for over a century.
Yep. And it strictly requires that any goods transported by water between 2 points within the United States must be carried on ships that are built in the United States, owned by U.S. citizens, crewed by U.S. citizens, and registered under the U.S. flag.
It is essentially a massive, century-old protectionist moat designed to foster and protect a domestic maritime industry and ensure the U.S. maintains shipbuilding capabilities for national security reasons.
That's the core intent.
But currently, the federal government has issued a waiver for the Jones Act. They are temporarily allowing foreign-flagged, foreign crewed ships to step in and move domestic goods between U.S. ports.
Right.
Now, let's put our strictly neutral reporter hats on here for you listening. We are not taking a political stance on whether this waiver is economically justified or detrimental. We are purely looking at the mechanics of why it happened, the arguments presented on the call, and most importantly for you, how it actually impacts Kirby's bottom line.
Right, just the facts. The mechanics of the waiver are tied to global energy volatility. The administration implemented this blanket waiver with the stated intention of easing supply chain bottlenecks and lowering fuel prices for everyday consumers at the pump.
Okay.
When you look at the geopolitical shocks occurring in the Middle East, the tensions in the Strait of Hormuz disrupting global shipping lanes, and the resulting volatility in crude prices, the administration's priority is stabilizing domestic energy costs.
Makes sense from their perspective.
By allowing cheaper, foreign-flagged vessels to move petroleum products between, say, the Gulf Coast and the Northeast, the theory is that transportation costs drop, and those savings are passed on to the consumer.
Right. That is the macroeconomic intent. But on the other side of the debate, Kirby's management team strongly argued on the call that the waiver is fundamentally failing to achieve that goal.
Yeah, they were pretty vocal about it.
CEO David Grabinski and COO Christian O'Neill stated that the actual cost savings to the consumer are negligible, amounting to maybe a penny a gallon at the pump. And they argued that while the consumer sees almost no benefit, the waiver actively harms American mariners whose jobs are being temporarily displaced by foreign crews.
Foreign crews who are operating under completely different labor and safety standards, by the way.
Exactly. Management explicitly stated that they believe the justification for the waiver has passed and it is time for it to end.
Again, we are reporting the tension without endorsing a side. The administration wants every tool available to combat inflation. The domestic maritime industry wants its statutory protections reinstated to protect American capital investments and labor.
Right.
But from an investor's perspective, the political debate is secondary to the financial reality. The real question is, did this waiver actually hurt Kirby's revenue in Q2?
And according to management, the material impact on Kirby so far has been incredibly minimal, like almost non-existent.
Almost zero.
Grzinski stated there has been zero impact on their inland river business and only a tiny bit of friction on the coastal side. But why? If foreign ships are allowed to undercut them on price, why hasn't Kirby lost a massive amount of market share?
It comes back to how they structure their commercial relationships. Kirby is not out there hustling for daily spot market jobs, fighting for every single cargo load against whatever foreign ship happens to be in the harbor.
Right. They aren't on Uber for barges.
Exactly. The vast majority of Kirby's fleet is locked up in long-term, multi-year term contracts with major refineries. These are deeply integrated, highly complex logistical partnerships. A refinery relies on Kirby's specific barges with their specific safety ratings and specialized crews to show up on schedule day after day, year after year.
They aren't going to break a multi-year contract and risk their entire supply chain reliability just to save a fraction of a cent on transportation by hiring some random foreign vessel that got a temporary waiver.
Exactly. So while management is deeply frustrated by the policy on principle, and while some of their smaller competitors who rely entirely on the volatile spot market might be feeling the pinch of foreign competition, Kirby's actual earnings and utilization rates have not been materially damaged.
Their contractual moat protected them from the political volatility.
It sure did.
Okay, so the marine business is structurally sound. The fleet is sold out, demand is locked in by record crack spreads and heavy crude imports, and they're weathering the political storms without taking on water.
Unintended.
Always. But here's where this deep dive gets really interesting. Because if Kirby were just a barge company, it would be a solid, perhaps slightly boring dividend-style value stock.
Totally.
But they aren't just a barge company. Let's pivot completely away from the water and talk about the distribution and services segment, because this is where the growth numbers start to look a little wild and where the narrative shifts from industrial logistics to the cutting edge of the tech economy.
Yeah, this is the fun part.
Power generation revenue in this segment is up 8% year over year. What exactly is driving that?
2 words: data centers.
Data centers.
We are currently in the middle of a massive, structural, once-in-a-generation boom in artificial intelligence and cloud computing infrastructure. The sheer scale of the server farms being built right now is unprecedented. And all of those tens of thousands of specialized AI processors requires an unbelievable amount of electricity.
Right. Power is the ultimate constraint on AI. You can have all the advanced chips in the world, but if you can't plug them in, they are just, well, expensive silicon paperweights.
Exactly.
But what does a marine barge company have to do with powering an AI server farm?
This is where Kirby's secondary business shines. For decades, they have sold and serviced massive industrial diesel and natural gas engines. Historically, this was for oil and gas fracking equipment or backup generators for hospitals. But now, the primary customer is the tech industry. And it goes far beyond just backup generators. Traditionally, a data center would buy a diesel generator for what the industry calls standby power, an engine that sits idle 99% of the time.
Yeah.
just waiting for a hurricane or a freak accident to knock out the local power grid.
Right, the emergency backup.
If the grid fails, the generator kicks on to keep the servers alive. But what is driving Kirby's explosive growth right now is not standby power. It is an insatiable demand for behind-the-meter power solutions.
Let's translate that jargon, because behind the meter is the key phrase that unlocks this entire thesis. What exactly does that mean from an electrical engineering and a business standpoint?
Behind the meter means power generation that is located on the customer side of the utility meter on their physical property. Instead of relying on the local public utility grid for their primary day-to-day electricity, these massive AI data centers are literally building their own private on-site power plants.
Wait, they are essentially becoming their own utility companies.
Pretty much.
But why? Why wouldn't Microsoft or Amazon just call up the local utility and say, hey, we are building a data center, please run a bigger power line to our building?
Because the public utilities physically cannot move fast enough. The grid is constrained. The interconnection queues, a waiting list to get a massive new industrial facility hooked up to the public high-voltage transmission lines can take 3, 4, even 5 years in places like Virginia or Texas.
5 years.
Yeah, and the tech companies are engaged in an AI arms race. They cannot wait 5 years for a utility to build a substation. Furthermore, the public grid is not designed for the sheer density of power required by modern AI clusters.
Right, AI chips are power hungry.
Very. A traditional data rack might draw 5 to 10 kilowatts. A rack of new AI GPUs can draw 40 to 100 kilowatts. The local grid simply doesn't have the baseload capacity to handle that without causing brownouts for the surrounding neighborhoods.
So the tech giants bypass the grid entirely. They buy massive natural gas reciprocating engines from Kirby, install them right next to the server farm, and generate their own primary power, 24 hours a day, 7 days a week.
Exactly. And they choose reciprocating engines, which function similarly to a massive car engine with pistons, rather than gas turbines.
Why is that?
Because reciprocating engines can start up incredibly fast and can easily load follow.
Load follow.
Meaning, if the data center suddenly spins up a massive computational task and power demand spikes instantly, a reciprocating engine can throttle up in seconds to meet that demand, whereas a traditional turbine takes much longer to spool up. Kirby is the premier distributor and packager of these specific, highly sought-after engines.
And this brings us to the single most jaw-dropping number on the entire earnings call. It is a number that completely changes the valuation model for this company.
Yeah, this is the big one.
Management updated their guidance for their power generation backlog. For context for you listening, the backlog is the total value of inbound signed orders they have received from customers but haven't yet delivered, built, or billed for. They increased that guidance to a massive range of $1 billion to $1.5 billion.
Wild.
Let that sink in. $1.5 billion of future revenue just sitting there on the books waiting to be executed.
It is a staggering figure. To put it in perspective, the total DNS segment revenue for the entire quarter was $385 million. They effectively have years of guaranteed high-margin work already lined up and signed. The demand is nearly infinite.
Right.
But, as with all things in heavy industry, there is a physical bottleneck.
Right, because if you have $1 billion in orders, the goal is to build them and recognize that revenue as fast as humanly possible. What is slowing them down?
The chief financial officer, Raj Kumar, noted that the actual speed at which Kirby can convert that $1.5 billion backlog into cash is entirely governed by the global supply chain. Kirby doesn't cast the raw engine blocks from scratch.
Oh, they don't?
No, they are a packager and distributor. They rely on original equipment manufacturers, the OEMs, the massive global engine builders, to deliver the core engines, the alternators, and the specialized electrical switchgear.
So Kirby is sitting there with a line of desperate tech and data center customers throwing money at them, shouting, "Take my $1 billion."
Yep.
And Kirby is standing at the loading dock saying, "We would absolutely love to. We just have to wait for the factory in Europe or Asia to ship us the raw engine blocks."
Precisely. The constraint on Kirby's growth is not a lack of customer demand. The constraint is the physical reality of the global supply chain for heavy industrial castings and copper wiring.
Wow.
But management noted that they're working closely with their OEM partners. And as those supply chain deliveries normalize and accelerate in the second half of the year, that massive backlog will start converting into recognized revenue at a much faster clip.
Okay, so if you are an investor building a thesis here, you have two incredibly powerful narratives running simultaneously. You have a sold-out barge fleet with rising pricing power on the water, And you have a $1.5 billion AI data center power backlog on land.
It's quite the combo.
How do these two distinct storylines translate into management's actual promises to Wall Street for the rest of 2026? What is the guidance?
The guidance is highly confident, but grounded in operational realism.
Yeah.
Management reaffirmed their target of 5% to 15% EPS growth for the full year. But they went a crucial step further. They specifically noted to analysts that they expect results to trend toward the upper end of that range.
Nice.
They didn't formally raise the bottom end of the range, likely maintaining a slight buffer for unpredictable geopolitical curveballs or hurricane disruptions in the Gulf. But their base case expectation is highly optimistic.
And they are projecting massive cash flow generation. Operating cash flow is guided to be between $575 million and $675 million for the full year.
That is a lot of cash.
It is. Now, they did note that Q2 had some elevated working capital requirements. Basically, their D&S business was growing so incredibly fast that a lot of cash got tied up in inventory and receivables.
Right, normal growing pains.
Plus, they had that delayed fuel reimbursement cycle in the marine segment that temporarily drained cash, which we talked about. But they explicitly expect all of that working capital to unwind and normalize in the second half of the year, leading to a massive flood of free cash flow.
The cash flow is going to be immense. But I want to zero in on a very specific exchange during the Q&A portion of the call regarding the marine margins.
Okay, let's hear it.
Because analysts were pushing CEO David Grzinski on exactly when inland marine margins would return to their historical all-time peak of 28%. Right now, those margins are sitting in the high teens. The analysts want to know when the rocket ship takes off.
And Grzinski's response was surprisingly measured, wasn't it?
It really was.
He didn't promise a sudden explosive jump to 28% next quarter. He told analysts to expect a multi-year slow march up.
Slow march up.
He expects slow, steady, low to mid, single-digit price increases compounding year after year, gradually expanding those margins over a 3 to 5 year horizon.
It is a phenomenal phrase, the slow march up. But to understand why that march is inevitable, we have to look at the structural barriers protecting Kirby's business.
And this is where I want to play devil's advocate. If I am a rival logistics CEO, or say a private equity firm with $1 billion in dry powder.
Okay, I see where you're going.
And I see Kirby raising prices on a sold-out fleet. Why wouldn't I just call up a shipyard in Louisiana, order 100 brand new tank barges, flood the market with new supply, and completely crush Kirby's pricing power? What is stopping competition from entering this highly profitable space?
If we connect this to the bigger macroeconomic picture, you have just identified Kirby's ultimate economic moat. The primary reason management is so confident in this multi-year slow march up is that new competitors mathematically cannot afford to enter the market.
Wait, really?
Really. The economics of building new maritime vessels in the United States are completely fundamentally broken right now.
Give me the hard numbers. Why can't someone just build a new barge to compete? A barge is essentially just a giant floating steel box. How hard can it be?
Management clearly laid out the map on the call. To justify the capital expenditure of building a brand new inland tank barge and the associated towboat today, current freight rates would need to be 40% higher than they already are.
Wait, 40% higher?
Yeah.
They are already at near record highs, and a competitor would need them to jump another 40% just to break even on a new build.
Yes. The capital cycle has completely detached from the freight rates. The cost of raw materials, specifically maritime-grade steel and specialized chemical-resistant marine coatings, has skyrocketed over the last 4 years.
Oh, wow.
Furthermore, labor costs in shipyards remain highly elevated post-COVID. Welding is a highly specialized skill, and there is a massive shortage of maritime labor. But the biggest factor is that overall shipyard capacity in the U.S. has physically shrunk.
Right, because of industry consolidation and shipyards going out of business during the lean years.
Exactly. So even if a competitor miraculously secured the funding and was willing to accept terrible returns just to build a barge, it's incredibly expensive. And they would have to wait years just to secure a slot in a shipyard because capacity is so constrained. As Grzinski put it point blank on the call, nobody's really or should be building equipment at these prices.
So the supply of barges is effectively physically capped. Nobody's building new ones because it is financial suicide.
Yep.
But on the demand side, the refineries and PD3s still need to move record amounts of heavy, crude, and refined petrochemicals. This is absolute economics 101. If demand is rising or even just holding steady and supply is rigidly fixed with zero new additions, prices mathematically must go up.
They have to.
Kirby has immense unassailable pricing power for the foreseeable future simply because the barrier to entry is a 40% capital premium that no rational actor is willing to pay.
It is a textbook wide moat business. And even the very limited construction happening right now, which COO Christian O'Neill estimated at about 60 inland barges industry-wide this year, is purely replacement capacity.
Just replacing the old stuff.
Yeah, those new barges are simply replacing 40-year-old vessels that are legally aging out and being sent to the scrapyard. It is not adding net new capacity to the market. The supply-demand balance is structurally, permanently locked in Kirby's favor for the duration of this capital cycle.
Okay, we have covered the financials, the marine dynamics, the AI power boom, and the structural moat. This brings us to the moment of truth. We promised you a talk ticker style actionable verdict, so let's deliver it. Based on this exhaustive Q2 breakdown, what does this all mean for you? Is Kirby a buy, a hold, or a sell?
Based on the structural advantages we've outlined, the data clearly points to a definitively bullish stance for retail investors. Yes, the fundamentals are strengthening across two completely distinct, uncorrelated business units. And the constraints in the market, whether it's shipyard capacity for barges or OEM supply chains for generators, are actively serving to protect and extend Kirby's pricing power and backlog, rather than erode it.
I am absolutely in the bullish camp as well. If you are looking at your portfolio right now and worrying about industrial cyclicality or tech valuations, Kirby offers you a very strange, very effective hybrid investment. Let's give you the 3 most actionable takeaways you can use if you are evaluating the stock.
Let's do it.
Takeaway number 1, the margin miss is a complete head fake. Do not let that 11% drop in marine operating income scare you out of a great asset. As we detailed, the sudden Q2 fuel cost squeeze is purely a 60-day billing lag in their pass-through contracts. Kirby is going to recover those costs in Q3. The underlying business of moving liquid cargo is as strong as it has ever been. The fleet is sold out, and margins are mathematically guaranteed to normalize.
Right. And actionable takeaway number 2. Aggressive diebacks signal extreme internal confidence from management. Kirby spent nearly $60 million on share repurchases in Q2 alone, at an average price of $142.38 per share.
$60 million in one quarter.
And they didn't stop when the quarter ended. In the first few weeks of Q3, just prior to this earnings call, they had already aggressively repurchased another $29 million worth of stock.
They are buying their own stock by the truckload. And remember, this isn't debt-fueled financial engineering. This is organic free cash flow.
Exactly. When a management team takes the massive free cash flow their business generates and uses it to aggressively shrink the float by buying back their own shares, rather than making risky empire-building acquisitions or hoarding cash, it sends the clearest possible signal to the market.
Which is?
The people who know the business best believe their own stock is fundamentally cheap compared to its future earning potential. They are betting on themselves.
And actionable takeaway number 3, the dual-engine growth narrative. As an investor, you aren't just buying one cyclical story here. You are getting a highly constrained, cash-flowing marine monopoly with an impenetrable economic moat paired with a backdoor pick-and-shovel play on the AI and data center infrastructure boom via that $1.5 billion power generation backlog.
It's an amazing combination.
Right. If the marine side ever hits a localized lull, the data center side is exploding. If OEM engine deliveries slow down temporarily, the inland barge rates are quietly marching up. It is an incredibly resilient, diversified portfolio housed within a single ticker.
It is a remarkably rare combination. You get mature dividend-style cash flow generation from the marine logistics segment, perfectly hedged by high-growth, tech-adjacent momentum in the power generation segment.
Right.
It's offensive and offensive at the exact same time.
All right, we have unpacked the numbers, we've analyzed the moat, and we have given you the verdict. But before we wrap up this deep dive, I want to leave you with one final lingering thread to pull on regarding that AI power boom.
Ooh, what is it?
We talked extensively about how Kirby is selling massive natural gas engines to data centers for behind-the-meter power. Management noted that their installed base of these massive generators is going to double in the next 18 months.
Double. That's huge.
And to handle that unprecedented volume, they are launching a new, highly specialized internal initiative called Kirby Integrated Power Systems, or KIPS.
Because, selling a multi-million-dollar engine is only the very first step in the customer relationship. The real, sustainable, high-margin money is in the service.
Exactly.
COO Christian O'Neill stated their explicit goal is to generate value in the aftermarket that actually exceeds the original purchase price of the equipment over its lifespan.
Exactly. And this is the thesis I want you to ponder as you look at your portfolio. In a world entirely driven by AI and cloud computing, data center downtime is the ultimate enemy. A power failure costs tech giants millions of dollars a minute in lost compute time and broken service level agreements.
They cannot afford to go offline.
They demand absolute 99.999% uptime. So what happens to Kirby's margins in 2027 and 2028 when all of those brand new behind-the-meter engines they are installing right now suddenly start hitting their heavy-duty cycles?
Oh, I see.
These engines will require constant, highly specialized 247 turnkey maintenance. They will need parts, overhauls, and remote monitoring. You aren't just looking at a $1.5 billion backlog of one-time engine sales today. You are looking at the birth of a massive, ultra-high margin recurring service annuity tomorrow.
It completely reshapes the long-term earnings profile of the company. It transitions them from an equipment seller to a critical infrastructure partner. It is a highly compelling question to consider as you evaluate the long-term potential of the stock well beyond the next quarter.
It really is. Well, thank you so much for joining us for this deep dive into Kirby Corporation. Keep asking the hard questions, keep looking past the headline numbers to find the actual cash flow mechanics, and keep diving deep into your portfolio. We'll see you next time.